Kotak Mutual Fund presents Investmentor in association with Network 18.
Hello and welcome to this special show. Kotak Mutual Fund presents Investmentor in association with Network 18, an investor education initiative by Kotak Mahindra Mutual Fund. Asset allocation is the basic principle that must govern any personal finance portfolio. The concept becomes even more important when you talk about investing in a bull market. So how can the right asset allocation help you limit risk and also deal with high market volatility? What are the basic asset allocation principles that we investors need to follow? And does the good old SIP approach work even in a bull market? Is that the best way to go? To discuss this and more, we today have with us on the show Harsha Upadhyaya, President and Chief Investment Officer Equity at Kotak Mahindra Asset Management Company, as well as Harish Krishnan, Senior Executive Vice President and Fund Manager at Kotak Mahindra Asset Management Company. Gentlemen, thank you very much for joining in and sort of taking up this very interesting and important concept. And Harsha, I want to open out with you because I think for a lot of people, making money in the last 7 to 8 months immediately after COVID, I guess got easier than what they would have anticipated. But looking at today's environment and the fact that over the last 1 month, the market has been marked by much higher volatility. What would your opening thoughts be in terms of the need to have the right asset allocation?
Clearly, I think there will be phases in the market which makes you believe that any investor can make money very easily. But if you're a long-term investor, you would have realized that such phases don't last long, and there is going to be volatility attached to every equity move. So to that extent, the past returns should not really drive one's asset allocation. At all points of time, investors should be careful in terms of what are the asset classes that they are getting into, whether they are correlated with each other, how much of their wealth should go into each of those buckets, etc. If I were to give an analogy of food, for example, we may like a certain kind of food, but that doesn't mean that we keep eating the same kind of food all the time. If you were to do that, there could be complications in health. Similarly, if you leave out some kind of a food, there could be vitamin deficiencies as well. So you need to have a very balanced diet. Similarly, when you are investing, you need to have a very balanced asset allocation so that you don't take excess risk, and also your liquidity needs in the later years are taken care of, and overall portfolio also gives you optimal returns. So that's the basic message that I would like to give at this point.
Harish, let me bring you into the conversation as well. I guess a lot of people don't think very holistically about their portfolios. That's another thing that, they dive headlong into equity, perhaps don't take into account the entire fixed income part of it as well. So what would your opening thoughts be, given that we are, investing in a very interesting second COVID wave sort of an environment?
In financial terms, don't put all your eggs in one basket. It's pretty much asset allocation. We all know that, there's a common used axiom in financial markets that there is no free lunch. But if there is one free lunch, it is that of diversification. Now, the beauty of asset allocation is that you bring in two uncorrelated or less correlated asset classes together. And by magic of diversification, you actually get better risk-adjusted returns. Now, this is a very simple concept that we've all been introduced to. We all shake our heads when we go through all of these knocks in life that, one shouldn't be entirely into one asset class, one shouldn't be entirely bullish or entirely complacent, and therefore one needs to look into it. One needs to be a bit more prudent. One needs to understand that each decision that one takes comes with a certain amount of risk, and one needs to balance it out. And therefore, once you combine all of this holistically, as you rightly put, rather than get carried away by the last 6, 7, 8 months, one needs to see the journey that, all these asset classes will take us through over the course of the next 5, 10 years. And when we start picturing us in that journey, I think a lot of decisions become a lot more easier in terms of constructing a very balanced and a holistic portfolio.
Okay, fair enough. Harsha, let me ask you about the options that investors have when it comes to mutual funds, when one is looking to sort of have a well-balanced portfolio. You have equity funds, you have debt funds, then you also have hybrid funds, and you have funds that move between both of these asset classes. So how to make the right choice? And tell us a little more about all the categories that are on offer.
Clearly, the two big categories are equity and fixed income. As the name suggests, these will be predominantly equity or fixed income funds. While equities come with higher volatility, the expected returns on equity is also higher as compared to fixed income. Fixed income investments move in a very, very small range, and to that extent, they can be considered as less volatile and more consistent. Now, combination of these two asset classes is what is provided through hybrid funds or asset allocation funds. In hybrid funds, the asset allocation may be fixed at a particular level, maybe 70-30 in favor of equity or 50-50 in favor of equity and fixed income, etc. But in dynamic asset allocation products, the equity allocation essentially moves in line with valuation and the overall trend in the market. So to that extent, at higher valuations, the portfolio manager or the fund house will decide to reduce equity allocation, and at lower valuation levels, naturally, the allocation will increase to equity bucket. So these are the products which can be explored by investors, or usually the ones who are informed, they can take a call in terms of choosing an equity fund or a fixed income fund. For those people who are unaware of asset allocation and how to do that, I think some of the dynamic asset allocation category funds would be ideal, because in that case, they need not really worry about asset allocation. And the portfolio manager would be taking those decisions. And overall, at various valuation levels, your equity allocation and hence the rest of the debt allocation will also move up and down. And over a period of time, these funds have shown that the asset allocation done by the fund houses have been reasonably good in terms of providing sustainable and consistent long-term returns.
Harish, now let's talk about the current market and, the bull market, perhaps as some people would call it. Now, what would your view be? We've seen this heady rally, and now we've seen some concerns seep back in. So tell us this. Every time the market gets into the mode of a bit of euphoria or, a lot of excitement, some would say overexcitement, what are the first steps to take in order to limit your risk? What is the approach that a medium risk investor needs to take in such an environment?
So the investment is all about marriage of numbers and narratives, right? You obviously have earnings, which guide a particular, a numerical approach to how to play in the markets, and then you've got the narrative or the sentiment, which is how people and the collective behavior of various market participants in terms of impact prices. Now, what we've seen is that generally markets tend to be dictated by two broad emotions. The first emotion is that of greed, and the second emotion is that of fear. Now, it's very easy for anyone to keep saying that, one shouldn't be swayed by both these emotions. But however, one is in the markets, I think it is natural for these human tendencies to keep coming through. And therefore, an asset allocation is essentially a check on both these extreme behaviors of greed and fear, so as to have a balanced kind of an approach to investments. Now, how do we go about doing that? So we've got obviously insights into how earnings and how business cycles are likely to perform in the future. However, as we all know, predicting future is not is never something that comes 10 by 10. You obviously have a probabilistic view of the future, but the more important thing is to look at how narratives are being spun around. Okay, and how do we kind of objectively track narratives? It can be in the term of, say, what has been the past returns for these asset classes. Have they been very lumpy? Have they come through significantly in the last, say, 1 to 3 years? Or have they been more average, like how they've been over the last, 10, 15 years? So, for example, while, as you rightly pointed out, the last 8-9 months makes investment look very easy. But if you take a slightly longer view of markets, Equity returns in, say, large cap or Nifty, for example, may have been more in the region of 12 to 14% if one takes a 5-7 or even a 10-year rolling return kind of a perspective, which is not very excessive. So therefore, one can keep a check on all of these kind of factors to try and see where we are in this greed and fear cycle, and then arrive at a reasonable optimal way to try and arrive at how do you make your overall portfolio. But the bigger thing is, what is your own goals? How is that risk profiling from that perspective? And basis that, if we can blend both of these, both the external worldview as well as the internal from a behavioral point of view, then I think one has a very good way to arrive at a decent, balanced or an asset allocation approach to investing.
Okay, fair enough. Well, let's do one thing. We'll take a quick break on that note. The conversation will continue on the other side. And we will ask Harsha a little more about the equity market itself. If valuations start getting lofty, then how does an investor approach the market? What's the right way forward? The conversation on the other side.
Kotak Mutual Fund presents Investmentor in association with Network 18. In association with Network 18.
Welcome back. You are with us on the next episode of Investmentor, and this week we're talking about the importance of asset allocation, especially in a bull market. Now, Harsha, this is going to be a question to you. And the thing is that, when the markets are in a what is called a risk-on mode, many a times a lot of asset classes start going up together. We see equities rising, oil prices rising, bond prices rising. So then sort of how should an investor look at making sure that he limits the element of risk that might be building in? Because generally asset prices are inflated across the board. Is there a need to go back to the drawing board then?
Yes, I think there has to be a continuous review of asset allocation. It's not that you can make an asset allocation and forget about it, because different asset classes move in a different fashion, and at various points of time the asset allocation that you have intended in the beginning would have changed. So to that extent, there needs to be a continuous monitoring and a review of that asset allocation. And as far as how to make that asset allocation work in all conditions is just to make sure that you don't take excessive position in any of the asset categories, given past performance or otherwise. One should look for non-correlated or less correlated asset classes. For example, usually equity and gold are two less correlated asset classes. Whenever there is a great panic in the equity markets led by economic downturn, you usually find gold seeing a lot of upward movement. So that's one of the examples. Similarly, you will have to look at all the asset classes that would be there in your portfolio and see how many of them are correlated and how many of them are not correlated or less correlated. And that gives you an idea in terms of how these asset classes would behave if something were to go wrong at some point of time. For example, even when you invest within the equity asset class, you need to see what are the kind of exposures that you have in various categories, large caps, mid caps, and also the thematic funds. Just to give an example, for example, if you have two thematic funds in your portfolio, one on the infrastructure side, one on the consumption side, these are not correlated asset classes. While equity as a whole will have some impact on these two asset classes, but the business drivers in these two segments are quite different. So you can definitely look to reduce the overall risk of the portfolio and also diversify in a good fashion. But if you have an infrastructure themed product in your portfolio and a capital goods or an engineering oriented product in a portfolio, that means that both these asset classes can move in a singular direction at many points of time. And the drivers are also mostly similar, which means that while you have two funds in your basket, these two funds are not really uncorrelated or less correlated. And to that extent, the overall behavior of the portfolio would be unidirectional. So these are some of the things that one needs to keep in mind. I've just given a few examples.
Sure. Speaking of behavior, and Harsha, I wanted to ask you this as well, because typically when we start seeing the market rally in a big way, emotions come into play as well, and both greed and fear. The greed comes into play when people who already have made gains, and if they're sitting on sizable sort of gains in their mutual funds or their individual stocks, they don't want to book profit. And the fear comes into the form of investors' mind who are left out. They don't know if it's the right time to get in. They worry about whether they're buying at the peak, and they want to wait for a correction, which sometimes doesn't come for months together. So how does one navigate this?
Clearly, retail investors find it very difficult to manage their emotions, greed and fear. Also, to take a call on asset allocation is very difficult for them. I think most of those investors should be looking for a financial advisor to understand better about their financial health and also in terms of managing overall investments for their future. Having said that, I think the asset allocation is important simply because what you mentioned, you are unable to control your emotions at various points of time. That is your greed and fear. Asset allocation helps you to manage your emotions in a way that that is optimal, and also it makes sure that investor doesn't take excessive risk, because there are points of time where many asset classes move together, which means that there is high degree of correlation between how some of these asset classes move. And similarly, whenever there is a downturn, many of the asset classes also fall together. So to avoid some of these excessive greed related or excessive fear related movements, one needs to have a prudent asset allocation and make sure that as far as possible, the overall portfolio has a lower degree of correlation with each of the asset classes that you own. And hence, any market move is unlikely to impact the overall portfolio in a singular fashion. Just an example is, for example, if there is equity and gold in your portfolio, these are two asset classes which are not so correlated or less correlated. So whenever there is an economic downturn and people are fearful about profitability of the businesses or continuation of the business activities in a normal fashion, people tend to move towards gold, which is considered to be a safe investment. Okay. So to that extent, if your portfolio has these two asset classes, then at various points of time when one of the asset classes is not doing well, or when there is excessive fear concerning one asset class, the other asset class may provide some degree of overall comfort in the portfolio.
As we're coming down to final thoughts, Harish, since for a lot of people equity is the first love, you tell us, I mean, and look at the current market context, how do you find this phase compared to the previous runs of the market where we've seen a big rally play out? People talk about valuations. Some people start comparing it with perhaps 2004. So is this looking like a bull market to you?
So from an earnings or business cycle perspective, clearly, we have come through a phase of the last 5-7 years where, there has been risk off from a business cycle. Businesses are consolidating, the weaker players are exiting, and overall credit growth in the industry has been very subdued. Now, this is not the first time it's happened. As you rightly pointed out, the late 90s had a similar such episode. And if you look even prior to that, maybe even the early 80s had similar such episode of a block of 5-7 years where things haven't really gone their way. Now, why is this important is to look at from a block of the next 5-7 years where a lot of these things can potentially reverse. And which is where I think we are reasonably positive on the overall business cycle. The fact that interest rates are low, the fact that tax rates have been brought down, all of them point to the fact that businesses and the overall investment drive will improve over the course of the next 5-7 years. However, if one is looking at a horizon of say 5-6 months, then we are talking of a completely different animal, because then we have to really think as to how much of this futuristic expectation of improvement in business cycle is already priced in. So therefore, if one is really genuinely a long-term investor, one is definitely a lot more positive the way things are today than what it would have been say a couple of years ago. And that is what underpins our overall asset allocation view towards equities.
Sure. So, Harsha, final word with you then. We're talking about the bull market, keeping our investments safe, using the mutual fund route. So recap the strict rules for us and also tell us the key mistakes that one should look at avoiding when the market starts sort of moving to very high levels.
One is about not taking excessive risk in a particular asset class, because if you just go by past returns and become bullish about a particular asset class, that may or may not work in the future. So I think you need to have all the asset classes in the portfolio, and many of these should be less correlated or uncorrelated with the overall portfolio. So that's the basic principle. And wherever you are looking at investments, you need to make this asset allocation and also monitor it continuously. Because if you start with a certain level of asset allocation between different asset classes, as asset classes perform over a period of time, this asset allocation will also change. So the idea is to make sure that the intended asset allocation is monitored and kept at a reasonable range all through your investing period, so that the experience is optimal. So, and in any case, the overall investment horizon should always be long term, because in the short term, it's very difficult to predict how some of these asset classes behave. And also there could be phases which are driven by external factors which would affect overall returns of the portfolio. So long-term focus and prudent asset allocation is something that will be key for successful investing for investors.
Okay. All right, gentlemen, thank you very much. I think this has been a very informative and important session for all our viewers who have joined in. Thanks very much for your inputs and your insights. Well, that brings us to the end of yet another episode of Investmentor. We look forward to getting you more conversations to help you make the right decisions with your investments. Thank you for watching.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.